Traders, where two average Joes beat the market. I am your co-host Eric, and I'd like to tell you and warn you all that we are on all your favorite streaming platforms. We are streaming live, so please get your questions in. Just a reminder here that in this block, Monday through Thursday at 11 o'clock, we have two live programs. On Mondays and Wednesdays, we have us, Paper Traders, and then on Tuesdays and Thursdays, we have free lunch with Ben Rains. So make sure you tune in. Again, get your comments in. We're streaming live. I can get all your notes right in here. We will address some things from the last show, including, what was that stock? CHGC, which is actually a Chinese stock, which we'll actually talk about in a little bit. But first, I would like to say that we have a special guest today, Zacks chief equity strategist and editor of the Large Cap Trader Service here at Zacks. He is John Blank, PhD. Welcome, John, to Paper Traders.
Eric, good to see you.
So, John, just real quick, let's give everybody a little bit of a idea of what you do here at Zacks. So if you could kind of give us a breakdown of what your responsibilities are.
Yeah, so I am the chief equity strategist, which means I write the monthly market strategy report, goes out to, 500,000 people. And I also have a resident economist, so I write a monthly economic report. And I am also the chief economist of that. And then I write the daily commentary for the Large Cap Trader, which is a top-down large cap, meaning 5 billion or over market cap stock picking service. That's my three hats.
Okay, and just in kind of like a short, I know it's a huge, broad topic, but could you explain to our viewers what a market economist is?
Yeah, so in general, there's three markets to be considered, the labor market, the goods market, and the capital market. So the labor market obviously is the unemployment rate and things of hiring and firing people. The capital market is loans and stocks and equities. And the goods market is what people actually produce, physical goods. You could add in services there, but the basic point is there's three markets, and you specialize in one or two of them. By being a chief equity strategist, I specialize in the financial market. By being an economist, I add in all three.
Okay, well, that is actually a whole lot of hats to wear and a whole lot to look at. John, just because we are a trading show and people are interested in the trading aspect, when did you yourself start trading? And if you do remember, what was your first trade?
Oh, man, I stayed with mainly mutual funds until I joined Zacks because I simply didn't understand stocks very well. And I did trade some ETFs. Particularly country ETFs, because I knew a fair amount about the international economy. I suppose that started somewhere around 2006.
Awesome. Well, now I think it's time to kind of get into the market news segment, which is pretty huge today.
Yeah, I mean, I'm sure a lot of investors are kind of getting, I wouldn't say nervous, but they're starting to kind of pay more attention to what's going on in the market. I'm sure a lot of investors kind of like to take I like to invest and sit back and not like look at my portfolio every day. But when you see these types of, I guess, trade wars and mortgage rates going down and all this types of things kind of happening and creating such a fluctuation in the market as we've kind of seen over the past few days, especially Monday, Tuesday, and now Wednesday, we've seen kind of these 2% huge moves in the market. And I'm just kind of curious on what exactly is your take on what's going on? We just got some, I guess, decent news from our end. Trump's delayed some tariffs on China, hoping for some sentiment better on the holiday season. And then we had the China Vice Premier and Treasury Secretary Steve Mnuchin talk yesterday, saying that we're going to resume these trade talks in about 2 weeks. I guess what can investors kind of expect going over these next few weeks or even months, I guess?
Right. So July the 26th, Eric, the VIX volatility index was trading at 12. Just to give you a relative idea what that means is the VIX volatility index today, when I checked this morning, was 21. So basically a doubling of volatility. So the latest tweet announcements and then partial retractions of consumer good tariffs has effectively doubled the volatility in this market. So where does this take us? It takes us back to a basic level of high volatility with no additional return. And that's what you got to understand here is a lot of what is happening in the stock market is bigger moves on the same amount of news flow. So the other thing I would point out as a macroeconomist, not a stock picker, is, for example, again this morning I looked over the last year and a half, and the US dollar to the euro is 10% stronger. The US dollar to the yuan is 10% stronger or so. So in the environment of putting on 10% tariffs, where the US dollar has already gotten 10% stronger, again, it's a wash as a result to the Chinese situation. And what we've seen in the Chinese PMIs, which indicate motion in their economy, particularly with manufacturing, which is the most at risk here, is they've gone nowhere. So the environment you're in is higher risk with no return.
So I guess, is there a place that, as an investor, we can kind of look towards, or, I mean, is everything kind of being hit overall? Because, I mean, I look at the stock market right now and I see just red, 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 red. Is there a place where, as an investor, I can kind of look for some safe havens? I mean, we see gold rallying, we see the mortgage rates going down, maybe a play in those types of areas. Again, we saw the delay with those tariffs, so maybe some retail. Is there a sector that, or maybe even a commodity that you're interested in, or is it just kind of one of those things you might want to sit back and kind of evaluate over these next few months?
Certainly the answer is to raise some cash. It doesn't mean to get out of the market entirely, but raise some cash. Second point is you're buying gold. It's a one-sided trade, and it's been already done to $1,500 an ounce. You might have a run to $1,600, but since so many people got in on the way up from $1,200 to $1,400 to $1,500, they're going to start taking profits on the way of you getting in. So, in general, gold is a short-term tactical trade to $1,600 with some upside, but a lot of risk again. So, the very simple point is, we have more risk with less returns, so you should stay in cash until that environment dissipates.
So myself, actually, I had a question. So would this be potentially a chance for value investors to take advantage of what's going on in the market? Would this be a chance with this dip and with the coming months, getting a stock that might necessarily not have been a good play, say a couple months ago, but now it's come down because of what's going on in China, and there's a chance that you're getting it for a good deal, and it could bounce back up once things kind of settle?
Yeah, value stocks are still dead until they're pronounced alive. So I would focus on really nice growth stock names at price earnings growth rates that are measurably good, and wait for them to pull back. I think there is some growth left in this marketplace. When and how this uncertainty dissipates, of which I have no answer to when it does. But I would still stay in cash and be very patient on buying dips, because this can go on for several months, which means you can get much better prices.
Right, and kind of going off of how you're kind of saying that you don't know how long this is going to hold out. Is this something that China is just going to kind of wait us out as we are waiting for these upcoming elections and hope for a change in the guard where they can get maybe a better deal on their side? Or what's going on in that kind of situation? I feel like we could be waiting almost years, if not months, because we have no idea who's going to be elected. We don't know if Trump's going to be reelected. There's so many uncertainties right now. Is this something that we could be waiting for quite a long time? Or I know you said you don't know any specifics, but I'm just kind of curious if you have any thoughts on that.
Well, there's a certain specific date that will give us clarity, which is November 2020.
Yeah, very true, very true.
No, and I've written this, guys. I don't want to be a jerk about it, but at the end of the day, I will quote myself this morning.
Okay.
The tariffs will be gone when the president is gone. The FBI can do an effective investigation into the intellectual property rights when Trump is gone, right? And the Chinese will have someone to deal with when Trump is gone. The other fourth point I want to make is the Chinese trade deficit is a function of the federal budget deficit. And you guys are smart enough that someday when I'm in the office, I'll put in a half an hour and explain to you that when you overspend, you overconsume, and if you overconsume, you'll bring in goods from China.
Mm-hmm.
So we have to also have a bipartisan commission to reduce the federal deficit and own it. That will reduce the Chinese trade surplus without ever speaking to them again. Now, again, the president must go for that to happen. He doesn't believe in bipartisanship. The bottom line is you have two paths here. One is he loses and he doesn't go. Not good. One is he wins and he gets confirmation that he's doing the right thing. The other is he loses, and then you have an administration that may or may not listen to someone like me.
Well, I mean, isn't that the whole problem then, too? I mean, we have that's really the gamble, I think, that China's really taking. I mean, nobody knows what the next year is going to bring. You know, there's constantly something in the news going one way or the other. I mean, it feels like China's really rolling the dice praying Trump doesn't come back in 2020 when at this point in time, who knows what could happen? And like you said, I mean, if it's one or the other, I mean, who's to say that the next, what's that phrase? It's better to know the evil that you have versus the evil that you don't have or something like that. Like, I can't remember the exact phrasing because, you know, this is a high situation. Right.
Versus one you don't. First of all, I just came from China. First thing you understand about China, when you go on the internet, you have to register yourself, and then you get on a very limited part of the internet in China, meaning the media control is complete. So there is no news or knowledge of what's going on with Trump or any of this stuff in the news in China if they don't want it to be there. Number one. Number two, China is a big country. And unlike a lot of the people who think we are in a bilateral fight, China is in a global perspective looking for opportunities in all parts of the world now. They will only treat us over time as a partner that's either very effective or very ineffective in that context. So the longer you're ineffective, the more they will shift away from dealing with you. For example, soybeans. They're gone.
Yeah, they stopped importing all our farm goods.
They're gone. But the Brazilians make a ton of soybeans. Their economy's in tough shape. Great. And there are meetings going on in China to basically create long-term agreements and soybean purchases with Brazil. So if you think through the three scenarios and you don't know what to do, you just say, look, just write them off. Why do we bother? Let's go after Brazil. So the point is, all that this will achieve is isolation from China's markets for us. And that isolation will just get more and more dense and more permanent as this type of approach continues.
Geez, well, let's take it here to a question that came in from Jamal Chester. It says, John, what's your current fundamental predisposition for Q3, Q4, and what brings you to your predisposition?
That's a good question.
Yeah, first of all, Q3 will look a lot like Q2 in earnings, basically a very soft slump. There's a call for a Q4 rebound of 8 or 9%. Do I believe that? That's really in the play here. So what I would tell you is the last earnings recession in 2016, what this one looks a lot like, was a 6-quarter earnings recession. We're going to get 3 in Q3. And if you think this thing goes all the way to the election, it can be probably 7 quarters.
Oh, wow.
Jeez.
So, I mean, going off, I don't mean to cut you off, but kind of going off, I've seen a lot of the big R word kind of being thrown around lately. Is that something we could possibly see? Or, I mean, what exactly is happening here? Is that something people should be concerned about? The recession?
Yeah, let me pull up a slide for you. I just pulled it up. And I'll share my screen.
Yeah, let's see it.
Let's do this.
Yeah, because, you know, I know a lot of investors don't really know, but there's a lot of, I guess, background things that are happening here that that could give us indications of a recession coming. And I'm not sure what was said or heard, but I think there's been something kind of going around, I guess, the grapevine that we're hitting some numbers in, I guess, slowing in the global economy. Is that something that's happening?
Yeah, I'll get through my slides here and show you what it's talking about. So
Oh, okay, perfect.
You see the yield curve inverts well in front of a recession, not at a recession?
Yep.
Okay, let's go through the last three inversions. December 1988, date of inversion, 1988 December. So the recession was 7 months later. March of 98, 10 years later. The recession was 3 years later. December 2005, the recession was 2 years later. So there you have it for your priors. When is the next recession? Anywhere using this data from 7 months, which is basically this January, to 2 to 3 years, which is well into the next term of whoever is president in this country.
Right.
I'll pull up another one for you that I thought was interesting. Will there be a federal debt debacle? I mean, we talk about China throwing themselves out of the treasury market, blowing it up. Truth is, with the interest rate inversion, that means the long end is getting lower than the short end. Government's more invested in the long end than the short end. And as you can see, actually, going back to 2010, we did 413 billion in annual interest payments. We do 500 billion now, which is another 90 billion, which is on a $20 trillion economy. So our annual interest payment is 2.5% of GDP. So actually, there is no risk to a default by the federal debt. In fact, we do have spending capability in the marketplace, and there's plenty of fiscal policy stimulus here to be had. I found this interesting. That's why I bring it up. You get a lot of doom and gloom in these places, and think the whole world's changed. But at the end of the day, look at this chart. As interest rates fall, and you're putting the money, you're getting cheaper and cheaper money, you're in better shape. So the point here is, it's not that simple of an environment for anybody to think about, but the risks also may be much less than you think. And I'm seeing that in the uncertainty, guys. I'm seeing that in economic uncertainty. It's not as high as 2016 right now.
All right.
So it is more durable, and it might just stay at 24 months, right?
So it's not all
staggering.
Right. So it's not all doom and gloom. We're not all kind of sitting here throwing out the R word. We shouldn't be kind of completely getting out of the market. It sounds like there's some growth left still here. There's still movement in the upside. We shouldn't be completely worried as investors. And I totally agree with that. So yeah,
2 to 3 years, guys. The last two inversions were 2 to 3 years before a recession.
Yeah, which gives us plenty of time, and that puts us in almost 2021. So
yeah, that puts us, or 2022, right? I mean, I will point out later to other people, is one of the things that happened. And again, you guys are educated guys. This is what the show's about. So I'm going to train you to use two words very differently.
Okay.
One is, when an economic recovery happens, that is when GDP levels rise out of a trough to the previous high. That's a recovery, meaning you just gained the ground back you lost, right?
Makes sense. Yeah, it makes sense.
In expansion, when someone says expansion, that means you go beyond the level you were at before.
Right, so you're exceeding that level.
Exactly. So don't ever let someone off the hook using we're in a longer recovery or a record recovery or a record long expansion. Because the point is, if you look at data on the United States, because of the depth of the recession, the recovery didn't happen until 2014. So this expansion is half the size of the cycle. It is 5 years long. And I see this in Los Angeles a lot. It was a very different world in 2014 than it is now. Now it's hot. Prices are rising. Very, very congested. 2014, not so much.
Last time I was in San Francisco, I saw studio apartments in a brand new building going up for $750,000.
Oh my goodness.
Yeah,
I
so
mean,
this is it. This is the end. And these are areas that probably got to recovery by 2010, 4 years before the rest of the world. And you're talking about the hottest areas, so that recovery in their GDP came back quicker, right?
right.
And
Well, I
they're
mean, there's a lot of business and industry on those coasts. I mean,
right.
New York's no
You just
different.
saw
Really,
today, Bungie, which is a very respected ag commodities group, moving from New York to St. Louis. Cheaper there, man.
Yeah,
But
oh yeah, by leaps and bounds.
there will be a different dynamic to this part of the expansion. But my point I want to make to you guys is the expansion is 5 years long.
All right. Well, in that case, I kind of feel like this might be a good segue.
Yeah, I think, John, it's time to introduce you to the Battleground.
Yeah, it's one of our favorite parts here. So let's just get right to it.
All right, John. So welcome to the Battleground. This is where you get a chance to look over the portfolios that we have and give us pointers and tips. And we usually bring a stock for everybody to look at and see whether or not we should keep an eye on it or get rid of it.
Yeah, but just before we get into that, I kind of have a general question on, I guess, people's portfolio, not just ours, but I guess in general investors. Is this, I mean, we've talked about having some still upward growth and a lot of expansion here in our markets. Is this something where we can kind of look to dollar cost average into certain stocks that we believe will continue going on? Or is this something we should kind of play a little bit more conservatively and kind of see what's going to go on in the next couple of weeks with, I guess, the talks here? Is the volatility going to continue, or is this something we can take advantage of?
You know, dollar cost averaging is beautiful because you will catch some of the lows and you'll miss some of the highs. And so that's a very good strategy in this environment. It's a very good strategy, and dollar cost averaging looks better in these environments than worse because you pick some of the lows off. You'll never get them picked on your own.
All right. Okay. Well, I guess, Eric, do you want to kind of lead us off, or do you want me to give a stock first?
Well, let's go and quickly take a look, see what we have here in
Okay.
the watch list. First off, just to refresh, we've got CRISPR, Elevate Credit, Callaway Golf, GoGo. What was that? That was a wireless company. Innovative Industrial Properties Inc., KB Home.
Yeah, they're a REIT. Yeah.
ETFMG, Alternate Harvest ETF, Square, Take-Two Interactive, Under Armour, and USA Mutual's Vice Investor, which we will talk about another day. That one's really one that we're not really currently looking at or taking seriously.
And Square, we could probably take off unless you want to keep watching it. I did add it, so it's one of those things.
Yeah, let's get rid of it
Okay.
because I don't feel like either of us. Well, you've made your choice. I don't think that's really one I'm going to end up taking.
Okay.
So we're going to get rid of Square there real quick. But overall, it looks like a lot of these aren't anything really to consider at the moment, I don't think. I mean, I'm looking at them. Nothing's really moved up or down. Most of the stuff's been down, but everything's kind of down now, so it's hard to...
I guess, John, I see one stock, KBH. Is that kind of a play that investors can look at with these interest rates going down and mortgage rates going down? They're at the lowest since, I think, 2016. So is it something that maybe that's a good play, or maybe the sector in general, maybe not just KB Homes specifically?
Well, I'll tell you what, KB Homes is over the last 3 months has done nothing.
Yeah, I think they were up like 0.8%, something like that.
Yeah, they've been flat since May, and they're at the top of the range. What I learned from the mortgage, what was interesting this morning is, back to my expansion recovery, there's basically been no real bona fide lift out of the mortgage market since 2014 from the 30-year mortgage perspective. So my basic point here is the same one. If you look at this chart, you should have bought the lows in late June, and you should be sold the highs in late July. And that's what you should do with KB Home. It's going to move around the $26 median mark, and that's fair value. That, in KB Home's terms, that is $2,900 on the S&P. Okay. So basically, you just got to be really religious and just punt over, pass, and kick.
Right. I like that analogy. That's something I can kind of relate to. So, all
You are
right.
not
Well,
a genius. There is no news, and nothing fundamental has happened.
right. Okay. Well, it's something that we have on our watch list. I think we're going to keep it on just because of what's kind of being said in the markets with this whole mortgage thing and everybody. You never know with the growth. Maybe consumers get a little bit more money in their pockets. Maybe they start buying some more homes in the next couple years. I'm not too sure. But the stock I actually wanted to take a look at was because of the recent delays in tariffs that we're putting on China. We saw a recent boost yesterday in certain retail stocks because of those types of things that they're able to take advantage of during the holiday season. So I'm taking a look at Best Buy here. And I'm just curious if you have any thoughts, if it was just kind of a blip in the retail sector. Is it maybe a short-term play that I could take advantage of? I see it's a Zacks ranked number 2, so we know the earnings are moving forward. And luckily, it's actually a value score. It's currently sitting at a forward PE of 12, so it's not too expensive. Is it something that we could look at as a short-term play with these holiday kind of sentiment moving forward as the positive, hoping that these tariffs do that for us?
I think into this Christmas, you can get this guy under 66 and then ride him to 78 and get out.
Mm-hmm.
And 10% return there. One earnings report on the 29th of August to be concerned with. Probably get a bump out of that, potentially. So it's pretty good short-term play here. I mean, again, just close the trade close to 80. Certainly 75 is plenty. Don't get greedy. There's not much in this market, like I said.
Right. Okay, that makes sense. So yeah, I'm going to throw this on the watch list, guys, and we're going to keep an eye over it the next couple of days here. So, Eric, did you have a stock that you wanted to?
So actually, I have 2 stocks. One
Oh,
of
you have
which,
2.
So John, this one's actually kind of special, and this goes out to one of our viewers yesterday who had asked this question, and I said I'd get back to it. And I looked at it, and I don't know much about it. And seeing as we have our international market champion here, John Plank, with us, I figured we could throw him at it. John, the ticker that somebody had sent to us was CBGH. Now, we don't have
CBGH.
CBGH.
B as in boy.
Yep, C is in cat, B is in boy, G is in good, and H is in hog.
It doesn't look like we
China
have much.
Used by United Guarantee International.
Yeah. It doesn't look like we have much information there available, but somebody asked, and I would feel really bad if I didn't actually answer this question for them.
The answer is there's no information to share, so we shouldn't be going anywhere with it. What it is a financial service provider focused on guarantee asset management and listing for China's small and medium enterprises. It provides equity financing, asset management, domestic and overseas capital markets listings. Just don't know enough about the stock. The business is somewhat interesting. It's nice to know about businesses like that this is a capital market play in China for the small and medium-sized firms. That's probably where we should go and go no further, guys.
Okay. Well, that goes out to the client yesterday who had a question for us, and I couldn't answer it. Hopefully, that gave you a little bit of information. Here at Zacks, I feel like you can correct me if I'm wrong here, John, but I feel like for the most part, if there's not enough information, you probably shouldn't be looking at it.
That's it. There's no edge for you.
So, okay, here's actually my pick, and I took it as an international play because it's YZCA. Yangzhou Coal Mining Company Limited.
You're just bringing mouthfuls today.
yeah, I am. But this one I had looked at just because the numbers look good. It looked like a pretty good valuation. It looks like it's actually at a low right now. And as I understand it, China is one of the largest consumers of coal in the world currently. So I was wondering if you thought potentially this is something to put on my list or whether or not I should just throw this out with the bathwater.
Market cap's about 3.4. Dividends almost 9%, Eric.
Wow. That's a hefty dividend.
Yeah. The chart's terrible.
Yeah, it does jack around a little bit.
The the way I would look at a chart like this, it's certainly not tradable. It's going down, and you don't know how much further it will go down. Things go down until they don't go down, and
Right, until they hit the bottom.
Yeah, that looks like
that is not a measure that can be achieved through any type of relationship. For example, the forward PE here is 4, which is incredibly low, but it was certainly here back in April when it was incredibly low at $11.50 a share. Now it's at 8. So until you see a stock like this turn up and exceed a prior high, not worth bothering with this guy. Just from a stock perspective, because right now, as we also discussed, it's not about the coal market. It's about money flowing in and out of China in the midst of a great deal of uncertainty. And what I have read and have advised is to stay underweight all non-U.S. equities until further notice. There is a chance here that the credit stimulus inside China will pick a stock up like this, but you aren't Chinese, so you're better off to wait till the big players move in and then get in around 9.5 or 10.
Fair enough. Okay, well, it looks like that I got to add that one to at least the watch list, because it sounds like that's something maybe to keep an eye on down the line here when things start looking a little bit more palatable. We'll see.
That's it. Again, this is our point about putting cash in. Just be real patient, man. I mean, you don't have to pick bottoms here. You're not going to get it right. You're going to pick.
No. Don't get greedy, right? That's kind of the number one rule.
What?
Don't get greedy. That's kind of the number one rule, right?
Right, that's it. I mean, you're just, there's no measurable like gram dot valuation metric that triggers any given stock. I've seen them turn at 120 P's and I've seen them turn at 2 P's. And you can't use that. So what goes on is whatever goes on, and you as a retail player cannot short stocks like this successfully and costly. It's difficult. And so you're just better off to wait till the big boys have covered their shorts and are going long. And that's what you're looking for on the charts.
All right. Well,
I feel like talking about covering some shorts, I feel like it's time to cut this one short.
Coming in with the puns. I like it.
So, John, I wanted to thank you for joining us here today. It's always a pleasure to have a real professional in the house that knows what's going on. And, I hope that you come back next time we hear a little bit of news and can give us a little bit more insight of what's going on here.
Yeah, we have a lot to digest. You know what? Leave some comments. We'd love to hear what you thought about this episode. I loved hearing everything we got today. Again, I'm going to try and digest a lot of this information. I feel like there's a lot to sift through, a lot of different sectors that you might want to deploy and look at. Maybe, like John said, gather some more cash and hold it in reserve. But yeah, definitely a lot to be kind of watching and get interested about and excited about, because like you said, there's still growth in this market, guys. We're not going into the big R word just yet. We do have some time, I believe, to go. So with that said, Eric,
Close us out?
Yeah.
Yes, I will.
Bring us out.
Yeah. Again, please leave a comment, like, subscribe. If you have a question specific for John we didn't actually get a chance to go and get a response to today, get in your chat box, write a little comment in there. We will go and either get it on the next show or reply directly within the chat. So with John Blank here, thank you so much. Don't forget to check out Free Lunch with Ben Rains on Tuesdays and Thursdays. And please also be sure to check out John's Large Cap Trader, available at Zacks.com. Thank you, everybody, and we'll see you Monday.